What's up, guys? Eric here. Huge news today. Here's today's headline. Adobe down almost 20%. Its worst day since 2010. They announced earnings. They also announced an acquisition of Figma for $20 billion. There's a couple of reasons why the stock's selling off. We're going to talk about those reasons today, give you a little bit of background about Figma, what it's all about. We're also going to look at a chart. I'm going to tell you where I think the stock could go. So Adobe announced Thursday it's going to acquire software firm Figma in a deal worth about $20 billion in cash and stock. This is a big price tag. Part of the reason why the stock is selling off is down close to 20%, over 17% last time I looked. We're going to look at a chart here later. It was founded in 2012, creates cloud-based design software that allows teams to collaborate in real time. Essentially, this is a competitor, and the CEO was actually on CNBC earlier. He talked about the reason they want to do this acquisition is to accelerate top-line growth. And really, if you look at the top line growth, it's starting to decelerate. They're trying to ramp that back up. He also thinks they can continue to be profitable with the earnings per share. So in other words, they're so profitable, but that absorbing this is not going to impact their profitability, and it's going to increase their top line growth. The problem is the company was valued at $10 billion in its last funding round in 2021. And if you think about 2021, it should probably be worth less, right? Most things since 2021, especially growth stocks like this, or growth companies, it's a private company, a lot of them have lost 50, 60, 70, 80%. So you could argue that it's probably not worth 10 billion and they paid $20 billion. So Figma is expected to generate more than $400 million in annual recurring revenue this year. So again, that's that top line number they're trying to help with acceleration. Adobe confirmed Figma's ARR will surpass $400 million exiting this year, 2022. So this means Adobe is paying in the neighborhood of 50 times revenue at a time when sales multiples for cloud software, they're contracting, right? Forward multiples have fallen to just 9 times revenue, and they were 25 times revenue in February of 2021, which is really the top for most growth stocks. Adobe says they're going to integrate some of the features in their products, such as illustration, photography, and video technology. Of course, Adobe sells a range of software services. You think of Adobe Photoshop, they've got photo and video professionals, so video editing, things like that. Photoshop, Illustrator, Premiere Pro, and more. I used to actually subscribe to Adobe Creative Cloud, and I canceled it earlier this year. It was just, I thought it was too expensive for what I got. And there's other platforms out there that are less expensive, even free. So the competition's been ramping up with Adobe. I sold the stock earlier this year around the same time I got rid of my subscription. Turned out to be a good move because I sold it at a much higher price. And it was very profitable because I owned Adobe for several years. Here's a quote from the CEO. Adobe's greatness has been rooted in our ability to create new categories and deliver cutting-edge technologies through organic innovation and inorganic acquisitions, M&A. The combination of Adobe and Figma is transformational and will accelerate our vision for collaborative creativity. They also get rid of a competitor, which is nice too. So once this deal closes, the Figma co-founder and CEO, Dylan Field, will continue to run the company. He'll report directly to the president of Adobe's digital media business. Adobe also announced their earnings, and they weren't terrible, but the guidance was a little bit light. So $3.40 a share, earnings per share. That beat estimates of $3.33, so they beat by 7 cents. The revenue is in line, $4.43 billion, which met expectations. The company guidance, $4.52 billion compared to consensus estimate of 4.6, so that's a little bit light. That's another reason why the stock is selling off. EPS, they actually are expecting to report $3.50 versus $3.47 on the forecast, so that's positive. The main reason why Adobe's stock is selling off so hard is because they're paying a lot of money, $20 billion for Figma. Here's a press release right from Adobe's website, from their investor relations website. So announced to enter a definitive merger. They're expected to close, I believe, next year. Adobe's mission is to change the world through digital experiences, on and on. Figma's mission is to help teams collaborate visually and make design accessible to all. So founded by 2 gentlemen here in 2012, the company pioneered product design on the web. Today, it's making it possible for everyone who designs interactive mobile and web applications to collaborate through multiplayer workflows, sophisticated design systems, and a rich, extensible developer ecosystem. Figma has attracted a new generation of millions of designers and developers and a loyal student following. So if you look at this, the main difference between the two is price. Figma is free for individual users, and you only pay if you want to have access to features like co-working. For Adobe, you have to pay before you even use it. So for smaller businesses, for creators, Figma was really popular because it was free. But I think it's probably going to alienate some of the users of Figma. I'm sure a lot of people are not happy about it. You also always have to worry about the two cultures merging together and how that's going to work. So Figma was founded in 2012. We talked about that. They have 850 employees. Total addressable market, listen to this, $16.5 billion by 2025. Well, the last time I checked, we're in 2022, and Adobe's paying $20 billion. And this is the total addressable market, not what their actual market share is. So they're paying a huge premium in hopes for future prospects. It's pretty speculative on the hopes of Adobe. And it really comes down to, I think, if you can't beat them, buy them. So they're expected to add $200 million ARR in 2022. I mean, that's great and all, but $200 million on a $20 billion price tag, surpassed $400 million ARR by fiscal year 2022. And they've got best-in-class net dollar retention rate, 150%. That's really solid. Gross margins are also 90%, which are very, very solid. Positive operating cash flows, thriving developer ecosystem, dozens of widgets, over 2,000 publicly available plugins, and Adobe and Figma are used by a large, growing number of joint customers. So there's a lot of customers using both, and it's going to simplify that for some of those customers. Real quick, just a couple of their products. They've got the Figma all-in-one product design platform you can kind of see here, and then they've got the online whiteboard for teams. Now, whiteboarding, I mean, you can do that even on Zoom. You can do it on Google Meets. You can do whiteboarding kind of everywhere. It's like one of these companies comes out with an idea and they all copy each other. It seems to be that there's no differentiators with a lot of those. But anyway, online whiteboarding for teams. I'm sure they have some unique features and things like that that integrate into their system and so on. This will all really fit into that Adobe Creative Cloud strategy. Let's move on to a chart. Let's look at valuation, see where the stock might go. Several members in Discord were asking me, where should you buy the stock? I said to be patient, wait a little bit, thought it was going to come down a little bit more. And you can see it's dipped a little bit again here. It's at $307.74. So it's going to try to hold that $300 line. It got down to 305 basically today. So it's 305 was the low today. It's bounced a little bit off of that. Let's look at a chart, see if it could go lower. Before we do that, P ratio shows here 36.29. Short interest is only 1%. Of course, it doesn't pay a dividend. When you think about a 36P ratio, it's getting pretty attractive. You could argue it's expensive, but it does have some decent growth. In this kind of environment though, no one really cares. So before I go on, I do need to announce this video is sponsored by The Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/fired up wealth. If this video is helpful, guys, drop me a like, drop me a comment. If you're new to the channel, click subscribe, click that bell to get notifications. So in our Discord community, we do chart day every single Wednesday. And a couple of weeks back, it's been several weeks, we said $396 was resistance and that was pressure for lower. We said it could go down to around this S3 line, which is closer to $319 or so. Of course, we had a fundamental catalyst, and any kind of fundamental catalyst like a $20 billion acquisition is going to trump technicals. That's going to always be more important than technicals. So it's driven it lower than its lower support level at an S3 here, and it's trading closer to $300 a share. Now, oftentimes when this happens, you'll have a couple of days for the sellers to kind of weed themselves out. Now, there's two sides of that. Sometimes it takes, you wait 2 days, you buy it on the third day, like midday of the third day. But sometimes there's knee-jerk reactions where things sell off very abruptly and you can get in and you can get a better price on the first reaction, on a knee-jerk reaction. It's really hard to say. I don't have a crystal ball. I think that it's attractive here. If it were me personally, I don't own this stock right now. I would wait for it to come below $300 and I would dollar cost average. Now, it might not ever happen. And if you love this stock and you really need to own it, you'd probably be nibbling it here and you'd be adding it lower. If you're looking for the best opportunity and you've got a watch list with limited cash, I'd watch this thing below 300. I can see it going maybe 295, 297, even lower. The thing is this could hold up at 300. It could go to 330 and do something like some of the charts we see where then it rolls over and it takes another leg lower, especially if the market collapses. So, I mean, this thing could go a lot lower, especially in these conditions, especially if we go into recession. There's a lot of things that are on the table that are risk. We had CPI that was running hot. We're going to have FOMC. If they come out and say they're going to do a 1% interest rate raise, well, that could make the whole market sell off again and you could see more pressure. So I'd be patient on this. It could bottom anytime. You need to hear me say that it could bottom anytime. I personally would want this thing under $300 and our dollar cost average. If this video is helpful, drop a like, drop a comment. I appreciate your time and attention. Have a great rest of your day. Take care.